This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In our previous lecture, we were here in section 6 looking at chargeable lifetime transfers. Now we know what they are, the transfers made in lifetime into a trust. And the clue's in the name as regards what we have to do with them. They are chargeable lifetime transfers. So they're not like pets where we wait around for 7 years to see if you die within that period and then the pet would become chargeable on the death of the taxpayer. Oh no, when that transfer into the trust is made, it is chargeable when made. So there was one computation, the first computation that we would have to do in terms of dealing with an examination question that involves transfers into trust, was to put that computation together, headed up, lifetime transfers chargeable when made. Using whatever was the nil rate band at that point, but given that we have had since 09-10 tax year 325,000 as the nil rate band, it's very unlikely to be anything other than 325. Now, if, as we saw in our examples last time, we had a CLT that exceeded the available nil rate band, then the excess over that 325 of the chargeable transfer would be chargeable, and then the question was, chargeable at what rate? And that all depended on, of course, who paid the tax. Now, there were either of two parties who may pay the tax. The donor, the person who's decided to put all of his or her funds, money, assets into that trust, they too can choose to pay the tax thereon. And if the donor pays the tax, then we know it as a net transfer. So that any excess in relation to this CLT, any excess above the nil rate band, that becomes chargeable, then that is taxed at 25%. It's said to be a net transfer, and we charge at that rate of 25%. That would establish then the amount of tax due on the CLT, which combined with the amount of the CLT itself, the chargeable lifetime transfer figure, we add the two together and we get the gross amount of chargeable transfers in relation to that specific transfer. If then, of course, the taxpayer dies within 7 years of having made that transfer, then it comes up in a second computation. And that, of course, is the lifetime transfers chargeable on death. Now, it will only be taxed if it arises within the 7 years before death. It's the only time that it will have the potential to have additional tax due thereon. So what do? In our lifetime transfers chargeable on death computation, we would involve both pets and CLTs made in the 7 years before death. But what we saw in the previous examples that we did in class, so far anyway, the illustrations that were shown, we had a CLT, and we dealt with it in lifetime, and we dealt with it both in lifetime and on death. Obviously, when it does become chargeable on death, depending how distant it is from the date of death, is it less than 3 years, or is it between 3 and 7 years from the date of death, we may or may not have taper relief to reduce the amount of charge arising on death. And of course, we do not pay both 20 or 25% in lifetime and 40% on death. So that when you've computed the tax charge, if there is one, the excess above the nil rate band, available nil rate band, taxed at 40%, we've applied taper relief, and then we deduct any lifetime tax paid. And that would bring you down to any additional tax due to be paid. Of course, if the lifetime tax turned out to be bigger than your tax charge after taper relief had been applied, then there would simply be no additional tax. You don't get any money back, but there's no additional tax to pay. But in the example seen last time, we simply had a CLT, a standalone CLT, made within the 7 years of the date of death of the taxpayer, and it was chargeable when made, and it was chargeable on death, and we sorted out that issue of who pays the tax. If it is a net transfer, why? Because the donor pays the tax. 25% is the tax charge on the excess above the available nil rate band. If, however, the donor does not pay, then there's only one party or parties who could pay, and those are the trustees of that trust. It isn't, of course, their own money that they are parting with. They are the trustees. They hold the purse strings of the trust, and therefore the money to be paid in tax would come out of that trust fund. If that were the case, then the transfer is a gross transfer, and we charge at 20%, rather than if it's a net transfer, as we've said, where we charge at 25%. But what we need to do now, before we progress any further, is to look at, well, what would happen if we had, say, more than one CLT that occurred within the 7 years before the date of death, and we also had a pet? How would we deal with that situation, both in lifetime and also then on death? And that is why here we have a little example for you. Now again, if you make a note of this particular example, I'll give you a moment or two to do that in just a second. But what we have here, if I just talk you through it, so if there's any problem reading my writing, you can understand what it says. We have our taxpayer X here, very appropriately X, because they've died. X died on the 1st of January 2022, leaving a chargeable estate of £500,000 to his daughter, as X's wife was independently wealthy. Now, it's not that here I or the examiner is justifying the reason why X has decided not to give anything to his wife but to give it all to his daughter. No, this is not a family issue here. What that is telling you is that there is a spouse. We've got a reason for not giving it. She's independently wealthy. You know, the problem when you've got so much money, you just don't need any more. Such a problem. But there is a wife there. So there is a wife. So we don't have a previously deceased spouse. If there had been a former wife, you would be told there. But if there's no previously deceased spouse, then there's no question of any unused nil rate band, or indeed even residence nil rate band applying here. There's only going to have his X's own nil rate band and resident nil rate band, if that is appropriate. And we don't have to wait too long to find out whether or not the residence nil rate band is appropriate, because we're told that his estate included a main residence, valued at £300,000, and it had no mortgage thereon, so there's nothing to deduct from that value. So what we know is that the chargeable estate went to his daughter. So we have a main residence passing to a direct relative, his daughter there, included within the estate at death, and hence the residence nil rate band. But just one, just his residence nil rate band will be available. Of course, it isn't just the death estate. In the exam question we get, there's going to be probably 2 or 3, maybe even 4 lifetime transfers that have occurred. And we're told here that X made the following chargeable transfers in his lifetime. I'll go through those with you in a moment. Just make sure, please, before then, that you've got that information noted down. And I'll pause while you copy that up. Okay, there were all those lifetime transfers there that had been made. I've told you here the following chargeable transfers. Now, in our next lecture, we'll understand rather more what we mean by chargeable transfer. It is clearly the figure to go to one or other of the IHT computations as being chargeable. What we saw very early on, indeed I think it was in our first lecture here on our chapter on inheritance tax, was how to compute a transfer of value, the loss to the estate of the donor. But that transfer of value, it's the basis, yes, of the chargeable transfer figure, and it may be one and the same. But as we'll discover in our next lecture together, there are, in relation to lifetime transfers, various exemptions that are available. Some of those exemptions are going to cover everything, so the whole lifetime transfer is exempt, and others will have values applied to them. Deductions, therefore, to be made from the transfer of value to establish the chargeable transfer figure. Now, we don't know about those lifetime exemptions yet. That, as I said, awaits us next time. So I have given you here the chargeable transfer figures. The figures to include on the relevant IHT computations, which of course will be in relation to lifetime transfers, the lifetime transfers chargeable when made, and the lifetime transfers chargeable on death. So what were these transfers? Well, in June 2017 here, a transfer to the daughter. A transfer to the daughter, therefore, that is a PET, a potentially exempt transfer, the value of which £175,000. Then, firstly, in October 2018, a transfer into trust set up for X's grandchildren. A transfer into a trust. That, therefore, is a CLT. And we see it happening again in March 2019, a further transfer into this trust, a further CLT. So when we see lifetime transfers, we are able to label them, whether they be CLTs, transfers into trust. If there are such CLTs, then as we know, they are both chargeable when made and, if made within the 7 years of the date of death, which is the situation that we have here, then they will also become chargeable on death as a result of course, the death of the taxpayer. We have PETs. They are only chargeable in relation to one event, the death of the taxpayer, and even then, only if the taxpayer sadly died within 7 years of making that particular transfer. But there's something else that we need to know, we may or may not be explicitly told, and that is who pays the IHT on the transfers made into trust. And we can see here that X had agreed to pay any IHT due on the transfers into trust. X agreed to that. That therefore means that we have net transfers. They are net transfers there that have occurred. If, of course, the question didn't tell you as to who had paid the tax in relation to the CLTs, then if you're not explicitly told whether it is the donor, whether it is the trustees, then implicitly you know that it is the donor. Because if the trustees are to pay, and they will do so if instructed by the donor is usually the principal named trustee for the trust anyway, that if you are not told who pays the tax, then it is the donor. That means that the trustees have not made any such election, so there's only one person left. It must be the donor. And if it's the donor, then again, as we go through the CLTs, chargeable when made, when we hit a point at which any cumulative 7-year total exceeds the then available nil rate band, that's still going to be $325,000 for us, then the excess is to be taxed. And if the donor pays, it's at 25%. That is the case here. And if, of course, it were the trustees to pay, then it would be at 20%. What have we been required to do? Compute the IHT payable as a result of X's death. Now let's think about that. When the taxpayer dies, that requires 2 IHT computations to be put together. They are the lifetime transfers chargeable on death. Do we have any lifetime transfers made within the 7 years of the date of death? Yes, we do. Our taxpayer sadly died on, the 1st of January? Not a good start to the year. 1st of January 2022 there. Going back 7 years would take us back to the 1st of January 2015. And the 3 lifetime transfers that we are informed about here are all post that date. June 17, October 18, March 19. They are all within the 7 years before the date of death. So they're all going to be chargeable. So there'll be a lifetime transfers chargeable on death computation that includes all 3 of those transfers. Again, working through chronologically from the oldest to the nearest to death lifetime transfer that has occurred. What we'd also need, of course, and we'll always have, and we know it, the chargeable estate at death, and that too would need to be computed, and again the tax thereon also calculated. But that first computation to be done as a result of death, the lifetime transfers chargeable on death, look at what we've got. We've seen that we've got 2 transfers out of the 3 that are CLTs. And when you compute any tax payable on death as a result of the taxpayer dying within 7 years of having made the CLT, then we are going to compute the additional tax due on death. To compute any additional tax due on death, then of course we need to know how much lifetime tax, if any, was paid. So, although it is not explicitly demanded, we are told we want the IHT payable as a result of death. If you're going to compute the amount of tax that was payable in respect of the lifetime transfers chargeable on death, then you're going to need to know whether any of those, either of those 2 CLTs, had any amount of lifetime tax payable in respect of them. So although it's only explicitly asked for 2 computations, lifetime chargeable on death and chargeable estate at death, implicitly we've also got to do the lifetime transfers chargeable when made computation. Now we know what we have got in relation to that. We have 2 transfers, the first of which £250,000. Now they'd probably tell you that in that there they've got the 17-18 tax year, this is the 18-19 tax year, this is also the 18-19 tax year. They tell you what the nil rate band was in those earlier tax years. But it's going to be £325,000 there. And you can see that £250,000, again, when made in lifetime, there were no CLTs made before that date within the previous 7 years. Because when you compute the tax on the lifetime transfers chargeable when made on those CLTs made in lifetime, the pets there that may have preceded them, as this one clearly does, that is made well within the 7 years of the both transfers indeed, those transfers into the trust. That makes no difference in terms of the IHT computation you prepare. Not for the lifetime transfers chargeable when made, because that only contains CLTs. There they are. There's, there they were. There was 2 of them there. And we know that the first of those is £250,000. And the second of them, £200,000. Now, with a nil rate band of 325 being applicable back then, and as we said earlier, it's been the case since 09-10 tax year, then 250,000 is within the nil rate band. That pet of 175,000 is ignored for this purpose. Again, it will be relevant when we come to deal with what was chargeable on death, but chargeable when made, it's just those 2 CLTs. If only we could see them there, but I think, again, into trust for the benefit of the grandchildren there. So on that 250 being below 325, it's all within the nil rate band. So there's no question of who pays the tax. There isn't any tax to pay. So the gross amount of transfer is 250. But then we come in with the next transfer of £200,000 there. And that £200,000, of course, added on. Remember, this is a cumulative donor-based tax. Added on to what will still be a gross figure of £250,000 for the earlier October 18 CLT. Well, when we tax this March 19 CLT, there will be what? 75,000 of the 325 nil rate bands still available. Remember, on death, we are talking about this is in lifetime, so we're talking about what was the nil rate band at the time. On death, it's about the nil rate band at the date of death. As we have said, ever since 09-10, it's £325,000, so it's going to be one and the same figure. So at 325, take away 250, That leaves 75,000 nil rate band available out of the 200. So 75,000, of course, will therefore be at nil rate, and the remainder of it will be taxed at, well, the rate that is relevant. You're going to do that computation in a moment, and that's exactly what I'd like you to compute. I'll see if I can restore the written words there. Hopefully you've got them written down. On those dates, October 18 and March 19, we had the transfers into trust. The trust was for the benefit of the grandchildren there. At least we can see the amounts, and we know that they are both CLTs. Okay, so if you could do the computation, please, of lifetime transfers chargeable when made, and establish the amount of tax that was payable in relation to that £200,000 figure, and of course, for where we go after that, what was the gross amount of that chargeable transfer? So again, pause at this particular point, and when you come back, I'll work through the answer to that one with you, before we then move on to the lifetime transfers chargeable on death, and eventually the chargeable estate at death. Okay, so let's look at our computation, therefore, in regards to the lifetime transfers chargeable when made. We pick up, of course, from the question the first of any CLTs that were made in the lifetime of our taxpayer. That one was October 18. Now, whether that date is within or outside of the 7 years before death doesn't matter. We need to record whatever was the first lifetime transfer made that the question tells us from within the question. Now, in terms of any exam question you get, then at this stage anyway, we're going to be looking at CLTs as here that were made within the 7 years before the date of death. But in a later lecture, what we will look at is what happens when actually there are CLTs made more than 7 years before the date of death. Clearly, they will not become chargeable on death. They would have been chargeable when made, by again reference to the then available nil rate band. As we've said, from 0910, it's been, as it still is, £325,000 there. So we would record whenever that first lifetime transfer was made. In an exam question, though, again, it is most likely to see at least one such CLT within the 7 years before death. You may indeed, as we'll see in a later lecture, don't worry, we will be covering this important point. There may be one that is 8, 9, 10 years before the date of death, but we still need to do it. The reason being, as you'll see at that point, and as we've emphasised all through our studies of IHT, this is a cumulative donor-based tax. So in computing either any CLT payable, any IHT payable in lifetime on CLTs, if you're going to be able to do that in a cumulative donor-based tax, you need to know what other CLTs were made within the 7 years of that transfer. October 18 is the very first one. So we have the full available nil rate band at that point, 325,000 available. We record the amount of the chargeable transfer, 250, in this little working column here. 250, of course, does not exceed 325 if you wanted to show a calculation, but given that you're doing objective testing questions on a scenario, a 10-mark scenario here in section B, you don't even have to do that. But what we know is that there is no tax on that CLT because we haven't exceeded the available nil rate band. But then we come to March 19. This is where the accumulation principle comes in. Were there any other CLTs made in the 7 years before it? Of course there was, October 18. So our gross total at the date of March 19 is that 250,000 gross figure. So in which case, we know that with a gross chargeable figure of 250 recorded for the CLTs made within the 7 years before the date of this transfer, March 19, that we now tax this CLT, this £200,000, based on we've used 250 of the nil rate band of 325, So the available nil rate band is 75,000, and that will be at nil. That means out of that 200, 125,000 remains to be taxed at 25%. Why 25%? Because we are told that X agreed to pay any IHT due on the transfers into trust. Therefore, they were net transfers, so we use the 25% rate here. That, do check it for me, but I think is £31,250, which means that the gross amount of that transfer, we've said it is a net transfer, the gross amount, the net plus the tax, is 231,250. And at that point, we'd have had, what's that, 481,250. So if there'd been another CLT, there wasn't, but if there'd been another CLT within 7 years of that first CLT, so by, what's that, October 2025, then your cumulative total at that point would be 481,250. So any and all of any such next CLT made within the 7 years from October 18, there'd be no nil rate band, and it would all be at, well, either 25% if the donor pays or 20% if the trustees pay. The importance of this, of course, was knowing that there was no lifetime tax paid on this CLT, and there was 31,250 on that second CLT. Why do we need to know that? Because the next computation that you're going to have to compute is headed Lifetime Transfers Chargeable on Death, the date of death being the 1st of January 2022. So what do we do in relation to that computation? Well, you've seen computations so far where you've had either just PETs made in the 7 years before the date of death, or you've had, as in the previous lecture, just a CLT made in the 7 years before the date of death. What we now have is both a PET and two CLTs. But again, remember the process. What is the date of death? Hence why I've written it there, 1st of Jan 2022. We go back 7 years. Back 7 years takes us to the 1st of January 2015. And we then come forward looking in the question for the first lifetime transfer made within that 7 year period. And that, of course, is this PET in June 2017. So we kick this computation off, therefore, with, here we go, June 17. Remember how we got that? Date of death, go back 7 years. That's the 1st of Jan 15. Come forward, June 17. That's the first lifetime transfer within the 7 years before the date of death. What was it? It was a PET. And how much was it? I've got it written here. No, I haven't. That PET was £175,000 there. And we record that. We only keep here a gross column going in addition to our IHT column. So it's £175,000. So clearly there's no IHT there. The next relevant date was October 18, when the first of the two CLTs arose. Go back to the previous computation. What was the gross chargeable transfer? It was the £250,000. That means you've now got a cumulative total of, what's that, 425,000. You've now exceeded the available nil rate band. So I'll need you, therefore, to compute the tax arising in relation to that particular transfer, before then moving on to have a look at, what was it, I'll leave a bit of space, but March 19, where you had the second of those two CLTs. So remind yourself, this is the lifetime transfers chargeable on death. We have recorded here that which happened in terms of such transfers within the 7 years before the date of death. But remember also, when you compute any such tax figure, as you will get going in there, when you've done the computation for it, then there may be a deduction or two that is available to come away from that. Hopefully you can recall that and correctly apply it here before moving on to do the same exercise in relation to the March 19 CLT. So again, pause at this particular point and try and complete this exercise computing what tax now becomes payable on each of the two CLTs payable as a result of the death of the taxpayer. Okay, let's see what we're looking at here, therefore. Now, we knew that the 250,000, using our cumulative figure of 175, the only transfer made within the 7 years before death that existed before the October 18 CLT, meant that with 175 on the clock, that left £150,000 worth of nil rate band available. That therefore would be at nil. That meant that out of that 250,000, we've accounted for 150, the remaining 100,000 at the death rate of 40%. And even I can do that one in my head, that was £40,000 there. So that's the first figure of our tax charge in relation to the lifetime transfer here, chargeable on death. But of course, that then may be reduced by either of two things. First of all, the taper relief. Have we, although dying within 7 years of the date of the CLT, has our taxpayer survived for at least 3 years? So the date, October 18, October 19, October 20, October 21. When did X die? 1st of January 22. So we have survived for at least 3, but not 4 years. So the taper relief for between 3 to 4 years, at the lowest level available, 20%, 20% of 40,000 would be 8, meaning that we've got additional tax due on death of £32,000. Now you'll notice there that I've gone straight to that figure is the additional tax due on death. Presumptuous of me, but still correct here. What we know is that there are two deductions that are possible, that are available. One, the first of which is always taper relief, but then any lifetime tax that had been paid in relation to the CLT. Well, if we recall, going back to the lifetime transfers chargeable when made, that figure was nil. There was no lifetime tax paid in relation to it. Now again, remember, given that it's likely to be tested in a section B 10-mark question, they're objective testing questions, you have to understand your layout, your workings in terms of making sure that you go about it in the correct process to get the right numbers, then to include in terms of your answer, i.e. which of those 4 answers is it? It's that one. But how you choose to lay it out is the quickest and easiest way that you can find, because it's a race against time in the examination room. So I'm showing you this is the proper format. You have to mimic this, but you don't need all the labels that I'm giving you here. You will simply know what needs to be computed, what needs to be deducted, what is the end answer I am after, and in relation to that October 18 CLT, in relation to the tax on it due on death, it's £32,000. But then there was the March 19 CLT that followed on, and that, remember, although we were told in the question it was 200,000, we want the gross chargeable transfer. And for that, you do not go back to the question, you go back to the first part of your answer. And there in the first part of your answer is the gross figure, £231,250. It is that figure that is now picked up and included within this computation. The tax charge, of course, will be at 40% there, and that figure will then go in. Well, what deductions can we make against that figure? Well, March 19, of course, there. Did we survive for at least 3 years? No, we didn't. March 19 plus 3 years would be March 22, died in January 22. So it means there's no taper relief that would be available. But what did happen this time is that there was, of course, lifetime tax paid. And that lifetime tax paid was 31,250, wasn't it? Yeah, there it is, the £31,250. That would now be deducted, 31,250, and you'd be deducting it from 231,250 at 40%. And I've made a note of that somewhere here. And I got that too. Yeah. Was that 92,500? Do check. 92, that is not a 7. 92,500. And when we take away 31,250, I got that to be, was that 61,750? Again, just check that those numbers are the right outcomes. Again, these are the right numbers. The CLT is 231,250. All of it is taxed at 40%. There is no taper relief to apply, but there is the deduction of the lifetime tax to give you that additional tax that was due on death. And that sorts out the first of the two computations required by the question that this sets, which was about computing the IHT payable as a result of the death of the taxpayer. Of course, to be able to do it, we needed to know that figure. We needed to know that there was no lifetime tax to reduce this 40,000 here. And that's why that implicit within that requirement was to compute the lifetime transfers chargeable when made computation and work out any tax paid on those CLTs in lifetime. That therefore gives us just one remaining exercise to perform. And guess what? Yep, I want you to do it. That is to compute the tax on the chargeable estate at death. The tax on the chargeable estate at death. Now we know what the chargeable estate at death is, given in the question 500,000. Obviously in an exam question, we may have to go through the various assets there and list them out to establish what amount of value was within that estate. What was the chargeable estate? But we've got it £500,000. We need to know how much of that is going to be taxable, that which is above the nil rate band. Well, here, if we had, we'd already got 425,000 by October 18, all of this within the 7 years before death. So when we'd have added in 231,250 to that 425,000, would have been well over 650,000 there in terms of our cumulative total of the lifetime transfers made in the 7 years before death. Meaning that is more than 325. So the nil rate band has been used. Remember, there's no question here of any unused nil rate band passing to X as the result of the earlier death of the spouse, and in a situation where she had not used or maybe even any of her then nil rate band. That is not an issue here. Clearly, that information will be clearly given to you if it is relevant in any examination question. So what we know is that all of the chargeable estate is to be taxed. That chargeable estate, as we have said, this is the chargeable estate at death on this computation for the tax on death on the chargeable estate. That was 500,000. So all I need you to do, therefore, is calculate the tax on it. So I'll pause here just for a second while you compute the tax on that. Okay, so did you remember, therefore, this 175,000 at nil? Yeah, I told you, as was and is the case, that there is no nil rate band still available. That's all been used up on the lifetime transfers that became chargeable as a result of the the death of the taxpayer within 7 years of having made those lifetime transfers. So there's no unused nil rate band. But what we have is a residence nil rate band. Remember, that's what we identified as we first read the information in the question. That first run through the information in the question is not sit back and take it easy and saying, oh, let's have a little read about what's going on here. It's actually spotting the relevant information Identifying, is that a CLT? Is it a PET? Is it an exempt transfer? What have I got there? If it's a CLT, is it paid net? Is it gross there? Sorry, is it net? Is it gross? Who's paying the tax thereon? What's within the 7 years of the date of death? And indeed, what nil rate band and or residence nil rate bands might be available. All of which is stuff we can pick up as we first read through. We haven't got time to relax in the examination room, just sit back and read the question. You've got to be focused every second of every minute there in that examination room. So 175,000 at nil, that therefore left the remaining 325,000 to be taxed at 40%, which is what, about £130,000 there in terms of the tax. Remember that, do check it, but I think 4 times 32,500. Yeah, £130,000 there of IHT. Remember that these are separate figures, that any tax arising in relation to a pet, there wasn't any here, but that would be payable and borne by the donee. They receive the gift, they pay any tax thereon. If sadly the taxpayer, the donor, dies within 7 years of having made it, and you happen to go above the then available nil rate band. In relation to the CLTs, then there is no donor left, the donor has just died. But what will therefore happen is that the trustees will have to pay the tax out of that trust fund, i.e. it's paid by the trustees, it's borne by the beneficiaries, the grandchildren in this particular case, because there's less left within that trust fund to eventually be distributed to those beneficiaries. And in relation to this, the chargeable estate, this is another separate liability. This one, it's payable by the personal representatives there, or executors as they're sometimes known, payable by the personal representatives. It's not money, that 130,000 is not coming out of their pockets. That will be paid out of the death estate. Now, if things need to be sold to realise the cash to pay that tax, then so be it. That's the job of the personal representatives. They there have to ensure that before any of the chargeable estate, any of the estate can be distributed to, as it is here, the beneficiary, the daughter as it was, that any tax has been paid thereon. Only then can the remainder after tax be distributed to the beneficiary. So it is payable in terms of the chargeable estate, payable by the personal representatives, it's borne again by the beneficiaries. There is less to be distributed to them as a result of the tax coming out of that death estate. Okay, that therefore hopefully just adds a little bit more in terms of understanding when these computations have to be done. If you've got multiple transactions within the 7 years before the date of death there, involving a combination of both PETs and CLTs, the process by which we establish the tax chargeable, tax payable when the transfers were made on the CLTs, the lifetime transfers that were chargeable on death, and then finally the chargeable estate at death. In relation to those lifetime transfers, I gave you, remember, the chargeable transfer figures. What you're going to discover in the next lecture, when we look at, I think it's section 7 on the exemptions there, is that how we already know how to compute the transfer of value, but how do we work down from it to the chargeable transfer figure? What exemptions are available in relation to those lifetime transfers? But that, as I say, is next time. After that, there will be a later lecture where we will look at the situation where you don't just have CLTs made within the 7 years before the date of death, but they could be more than 7 years before the date of death. And yet somehow, as we'll see later, they may still have a role to play in computing the IHT that is only payable on the transfers that occurred within the 7 years before the date of death. An old CLT more than 7 years before the date of death, there won't be any tax payable on it, but given the cumulative nature of this tax, though that 8, 9, 10-year-old CLT is not of itself taxable as a result of the death of the taxpayer, it may still impact on those transfers that are within the 7 years of the date of the death of the taxpayer, but are also within 7 years of that earlier CLT. And that will impact, given the cumulative nature of our computation, on the tax that is payable on those transfers. But that is another lecture that awaits us at a later point in time.